Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hello and welcome to this episode of the Australian Finance Podcast. My name is Owen Rask, and today I'm flying solo. I do not have any of my partners in crime, or shall we say co-hosts here on the show, because some of them are away and other things have consumed them at this time. But one of the things that I've been eager to do ever since we started our podcast in 2017 was to start doing more individual episodes where it's just me behind the mic or in front of the camera and you can hear directly from me. And you can ask your questions and I'll answer them on the show, or you can send in your feedback and information. What you're going to hear for the very first episode is a Q&A. And I'll always start the episodes in a particular way with a story, a theme, or something else before diving into the questions. And what I really want you to do is to send me your feedback. You can use Spotify. There's a feedback feature on there for each episode. You can write into us. You can send me an email. You can use the Ask a Question link that's available in every episode of the podcast and just leave feedback. You can select the Australian Finance Podcast, Australian Investors Podcast, basically any of them at any time. And you can leave feedback as well as ask questions. One of the things that I noticed leading into today's episode was that the question and names are something that we take a lot of pride in over on the Australian Investors Podcast. The funnier, the better. Here on the Australian Finance Podcast, I think I can say this because Kate's away, I think we need to increase the humor. So send in your questions and give us a funny name. And if it's really funny, we can give you something for free. We'll send you a goodie bag in the mail. As always, when I answer your questions, it comes with a general advice disclaimer. I don't know your personal circumstances, needs, goals, or objectives, so it's always important to seek the advice of a licensed and trusted financial professional before you act on any of the information. Fortunately, I don't give any personalized type responses anyhow, so always seek out a financial planner and read the product disclosure statement of anything that I mention, things like ETFs or super funds. And don't change super funds, in fact, until you've reviewed your insurance or got a specialist to do that for you. So, if you like these episodes, please let me know. It would be a great favor to me if you let me know how I can improve, future topics, so on and so forth. The link to send in a question is available in your podcast player. Just as a side note, all of these episodes are also available on YouTube, which lately has been probably our biggest driver of growth here at Rask. Whether it's shorts or video, you can get in contact and you can comment there on YouTube. So if you're watching on YouTube, hello, good day, and I'll see you next time. Today's episode is all about investing Q&A. So you've sent in your questions and we've got some great ones. But the story I wanted to start with today is something that's quite close to home for me. And it's all about individuality. And I think this relates to investing and finance and money in so many different ways. And I want to start with a story that I put together. When I graduated high school, I absolutely loved mathematics and engineering. Well, I didn't really know exactly what I wanted to do. I knew that something like specialist mathematics, for those of you that have taken it, you'll know what I'm talking about, was my favorite subject, and I think it was the one that I did best in. I think the reason that I like specialist mathematics is it allowed me to model and explain how different things in the world worked, predicting where a football might land, or even growing up on the farm, where my bullet might end up if I shot at a target that was a long way away. Growing up on the farm and playing sport, I think the knowledge that I could see in mathematics and learn from my classes actually helped me more in real life than I appreciated. After high school, I had a failed stint in the military. When I say failed, I just wasn't good enough. I couldn't huck it, so to speak, but it was very formative for me. My first degree was a degree in technology from Swinburne Uni. I chose technology because it helped me harness my curiosity for programming and engineering. It was like I could understand the world and try and recreate things. But I also took electives in economics and sociology because I was fascinated why people did what they did. And also, I had this real strong desire that I didn't want to grow up poor. I wanted to provide for my family, so I knew I needed to understand finance. A passion for science and finance then took hold. I ended up doing 2 master's degrees, a few diplomas, countless books later, thousands of hours of podcast listening, 10 years of investing, on-the-job trading, even some financial analyst study. I now run my own company in finance. I worked for another company, including the Motley Fool. I've bought property, started other companies. I even created my own NFT. And while I may be a little bit ashamed to admit it, I've owned Bitcoin for longer than I realized. I just lost my password, so I cannot access any of my cryptocurrencies. And throughout that time, I've been very humbled to speak with thousands of investors. Yet after all of this, I've also realized I made some major mistakes. The biggest financial mistake I've ever made was not realizing that finance is not about a spreadsheet. It's not about your maths brains. It's not about how smart you are. It's not about the books you've read or haven't. It's about none of that. Being good with money is about knowing yourself. Because it's only once you understand yourself that you'll be okay standing in your own socks. What I'm trying to say is everyone experiences this world differently. And those experiences shape how you see the world. Together with education, it's your experiences that shape your philosophy on life, money, love, and how you behave. And because money is both vitally important to our well-being and it is a taboo topic, far too few people talk about it. And the finance industry will never tell you that individuality is okay because they want to sell you a formula. This is why the late great Charlie Munger once said, "Envy is a really stupid sin because it's the only one you could never possibly have any fun at. There's a lot of pain and no fun." From Charlie's remarks, we can see that we shouldn't envy someone because they have more or pity someone because they have less. Don't envy someone because they know more or shame them because they know less. Your experiences will never be the same as theirs. So how could you compare? You may have had significantly better access to education. So how is that an apples to apples comparison? Today's episode is all about your investing questions. But as you'll discover, they are all totally different. From people at different life stages with different priorities, philosophies, and problems. As we go through and answer these questions together, let's celebrate individuality and learn what we can from each person's problem. The first question for today comes from Privileged Problemer. And this is a very good question to name. It's probably the funniest one in today's list. And they say, "I have too much money lying around and not sure what to do. I have 3 mortgages with offset accounts that are full, excess cash in a term deposit, no shares, bonds, ETFs, etc. I'm also unsure about the best investment vehicle as I have no kids, so family trust doesn't seem preferable. I'm also on the highest tax bracket, so paying a lot of tax. Unhappy face." So this is less a question and more of a statement, I guess. But this is a really interesting one and a really interesting way to start things off because not many of us talk about having too much money and that being a problem in our lives. For most of us, it probably seems like, isn't that a good problem to have? Interestingly, what I've found is that, and I've been very privileged to speak to many people, some people who may be considered billionaires and some people who are indeed billionaires, some people that have received hundreds of millions of dollars in wealth that's come down from family members, some people that have built businesses that have gone on to be multi-billionaires and huge successes both here and internationally. And what I've found is that many of those people can also be some of the most miserable people that I speak to. And it really is true what they say, in my opinion, that more money does not equal more happiness. And so when I hear things like this, I tend to think of the old saying that if you don't know where you are headed, any path will take you there. It's a quote that I can't remember who said, but it springs to mind in this instance because if you have enough money, yet you still strive for more, why are you doing it? Fortunately, my co-host Kate Campbell said in her book that one of the things you can do to understand your relationship with money is to design your ideal Tuesday or Saturday. It's an exercise we've done here on the show quite a few times, and it goes like this. One of the things you can do is sit down and with a single piece of paper or your phone, or just do it in your mind as we go through, heck, you could even do it with just emojis that represent the key items of your day. Start with how you're going to wake up in the morning. Do you wake up? Who's there with you? What are you doing? Where do you go for breakfast? Are kids in your life? Are kids not in your life? Do you go to work? Do you not go to work? What do you have for breakfast? And you go through the day describing what your ideal Tuesday, which is typically a working day for most of us, you go through that What does your evening look like? When do you go to bed? What are you doing? Do you watch Netflix? Do you go for a run? Do you make dinner? Do you eat out? What is it? You put that piece of paper down and you grab another one. And now we're going to do the exact same exercise except for a Saturday. Maybe on a Saturday you sleep in an extra hour, maybe 2, maybe more, and you start in a different way. Maybe you work around the house, maybe you do something with the kids, maybe you don't have kids yet, so maybe you catch up with friends for brunch. You could do whatever you want to do. It's your ideal Saturday. What you'll find, and I think what most people find when they do this exercise, and when I've done it with them in the past, is that their ideal day is not that far away from where they are now. Yet many of us are striving for more. We strive for more money, more things, and we see these unrealistic realities played out on social media in particular. But when people actually sit down and do this activity, they find that, hey, things aren't that far away from my ideal day. All I've got to do is tinker this and this. Now, of course, you may be in a situation where you hate your job or you think you hate your job and you want to get out of it. This is a good activity to really stretch your mind and understand, by looking back in on yourself, what it is that you truly want. By doing this activity, I find that a lot of people particularly as they go down the journey of creating wealth for themselves and snowballing and compounding their money, they can sit back and they can ask themselves, what am I actually doing this for, and how will I know when I get there? Morgan Housel has this great quote that being financially free is about doing what you want, when you want, with who you want. But if you don't know what you want, you don't know when you want it, and you don't know who's important in your life, well, you're never going to know, and you're going to keep striving for more, probably aimlessly. By doing this activity, someone in this situation would be able to understand, well, I know where I want to be, I know how much I'll need to live that life, and I know who should be in that life with me, and I'll prioritize them now. In my opinion, someone that has such a situation where they might have a lot of money and they might be ready to take on that new role in their life or new journey in their life, they actually find themselves at a bit of a crossroads and a bit unsure of making that final decision. So one of the best things you can do is reach out to someone who may be on a similar journey, read a few books, maybe of a financial independence, retire early book, like the book from Dave Gow, which is Strong Money. Or maybe it's seeing a financial planner or just sitting down with your partner. As for the actual practicalities, these are very, very easy to work out once you know which tools are available to you to get you to where you want to be. Family trusts, as we know, can help people with higher incomes, but that's not all. They can help people who have businesses. They can help people that have kids or kids in their family, so they can split money, or even their partner. It can help minimize tax or help, mitigate some of the tax burden. At the end of the day, though, if this person hasn't invested, I think that's probably the first thing to consider. How do I get invested? How do I do that safely and comfortably? I think the same rules apply no matter how much money you have. Start small and start soon. That way you get a feel for it, which is the hardest bit of investing, is feeling comfortable that you are able to withstand the emotional ups and downs of investing. This is a great question. And now we might move to the next question, which is all about this individuality. We're going straight to the other end of the curve. This question comes in from Mike. Mike says, I'm an 18-year-old living at home with a casual job that I have had for 3 years. What ratio of savings to investments is ideal right now? Well, Mike, I can't tell you what to do when it comes to investing. I can't even tell you what's right for your situation. But what I can say is for anyone, generally speaking, that's living at home that may be thinking, I'm listening to the Australian Finance Podcast, what can I do? Everyone seems to be talking about kids or retirement or, investing big amounts of money. I'll give you a tip. Not everyone's investing big amounts of money. In fact, most of us aren't. So I think being at home can suck, let's be honest, but there are many advantages. One of those is that costs are extremely low. So a lot of the financial liabilities that you might have later in life simply aren't there. I remember back when I was younger, I started investing around the age of 20 years old. And while living at home, I was able to invest a lot more money than I was just a few years later, as I decided to move out with some friends and into a share house. The key thing is that most people who listen to this would be comfortable if they could save 20% of their income and put that towards future you. And by that I mean, most of us have probably read something like the Barefoot Investor book or even taken our free budget course on Rask Education and seen that that's something that I followed for a long time, was trying to put 20% of my money jar straight into long-term investing. And then even when I was younger, I knew that I could probably pull that out in the future. I don't have that many financial responsibilities. I know they all say don't invest money that you might need in the next 3 years, but I could pull it out. If you're self-employed, you probably want to save more than that because you're going to have to allocate around 10% of your money towards superannuation. Even though you don't have to do this necessarily as a self-employed person, I think it's really good practice to put some money aside, because I've come across many people in the construction industry, like tradies, people that work in the gig economy, in the creative arts scene, that may not necessarily have stable jobs or necessarily one consistent employer. They get to about 30 years old and they realize that all of their friends have probably $50,000 or $150,000 in superannuation, and they've got $5,000. And so that actually becomes a pretty meaningful problem pretty quickly, because that $100,000 at 30 would be worth significantly more by the time they retire. So try and get that extra 10% in if you are self-employed. But for everyone else that's on PAYG or works in a stable job, that should be paid for you by your employer. So the other 20% should go towards future you. Other than just saving that minimum amount, however, when you're young, you probably have a chance to save a lot more. I consider when someone's younger and has less responsibilities, that the ideal rate of saving is probably as much as you can. And for many of us, that's over 50% of our income. You've probably heard me say on the show before that a lot of people obsess about investing when they haven't even got $100,000 invested yet. And so what I mean by that is a lot of people come on these shows, come on podcasts, and they talk about which ETF should you buy, which stock should you buy, which broker should you use, all of that stuff. But really, as long as you just make an okay pick at every one of those things, none of that really matters until you get more money in the bank. What really matters in the early days is how much you earn and how much you keep. The other stuff, it's just one little decision on your road to a much bigger and better financial future. So don't overthink those things. Just get invested and start saving more. Saving an extra $2,000 or $3,000 a year when you only have $5,000 in your brokerage account means so much more than trying to get an extra 1 or 2% annual return or picking a broker that saves you an extra $2 or $3 here or there. That stuff doesn't matter. What matters is how much you save and how you go about earning money. So I would say try and invest as much as you can, as early as you can, keeping in mind that you probably will be paying board and having other responsibilities if you're a younger person. And if you don't know what to buy, you can just copy some of the stuff that we've mentioned online. Like you can go to our free account pages and get yourself a free Rask account, and in there we name some of our favorite ETFs. You can listen to podcasts and you can do your own research, of course. If you're looking for brokerage accounts, we actually have a free report. If you just Google best brokerage accounts or best share brokerage accounts on Rask, it'll come up with a list of brokerage accounts. Obviously, we have some sponsors of the show, including Perla, who you've heard us talk about before, and others have come on the show many times before. I think one thing that I would also say, and this is more of a tongue-in-cheek thing, it's a bit of life advice, if I may throw it out there as individuality comes to the fore, is don't become one of those 20-year-olds who don't go out, who don't go and have fun with friends or go and experience the world. Don't be one of those people who opt to save an extra $200 and not go on that trip away with your friends. You see, I think it's really important and formative for us as young people to go and experience the world and to go and take it on, because later on in life, you don't have the luxury. When you get to 30, trust me about this, you don't want to be the silly one, the one that everyone starts to cringe a little bit more about when they try and act like they're 20. Be happy and embrace being 20. I think an easy way that most people can do that is just allocate at least 10% of your income, your savings, at least 10% of that to going on holidays and experiencing the world. For those of you that follow the Barefoot Investor book, I think he called this the splurge count or something like that. But as a young person, I would say the most important thing is that you enjoy life as well. I hear from the financial independence community that saving too much is actually one of the things that really they regret. Another thing to keep in mind, and if you're sitting at home thinking, or wherever you're listening to this or watching this, if you're sitting there and you're thinking, well, maybe everyone else has more money than me. What is really interesting is that when I pulled up the numbers, I think this was last year, so 2023, when I pulled up the numbers, what I realized, according to a few studies from Westpac and NAB, the big Aussie banks, is that the average Australian banking customer has around $22,000 in the bank, give or take. If you're 18 years old, 19 years old, 20 years old listening to this, $20,000 in the bank by the time you reach 25 is probably quite achievable. And I think after all is said and done, if you're in your teens or early 20s and you listen to the Australian Finance Podcast, I'm very confident that you'll be okay. So just enjoy yourself, have a bit of fun, learn about finance, get invested, and don't sweat the small things. The next question comes from Matthew, who asks, what are your thoughts on leveraged ETFs, specifically holding for the long term? For those that don't know, BetaShares is a long-term sponsor of the podcast, and we recently did an episode with them on leveraged ETFs. The idea of a leveraged ETF is kind of like a mortgage on your home, except you use debt to grow the value of your exposure to investing. So meaning that the ETF itself has debt, it holds debt, and that magnifies the returns and the losses that you receive from your investing. Obviously, these things are not for the faint-hearted, and they are higher risk for the very reason that they do go up and down quicker than most other things that you'll see on the stock market. In fact, if you look at the top performing US ETFs on any given day, I can almost guarantee you that the top performing are always triply leveraged ETFs, or even more leveraged in some cases. And on the worst days, the same in reverse, the triple leveraged ETFs that fall faster than anything else. So, they are not for the faint-hearted. We do not use leveraged ETFs at Rask. Now, I can understand why some of these ETFs might form part of someone's portfolios because some of the ETFs have indeed done very well over the long term. But for the most part, we believe that you do not need leveraged ETFs in a traditional portfolio. So none of our Rask Invest portfolios have them included. However, I can understand why many investors with smaller balances might use them, or, however, why some investors might use them as a satellite allocation alongside their core portfolio. That is a bit more vanilla, which is a little bit more boring. There are other ways to use leverage in investing. So you don't just have to use a leveraged ETF. You can use a loan that goes against a share portfolio. I'm going to answer a question on that in a moment. Or you can use some of the other things that you might have come across on the internet. There are two things in particular that I'll call out. Many people that listen to the Australian Finance Podcast, I know, have heard of something called the NAB Equity Builder. And many people who listen to the show might also know that our sponsor, InvestSmart, also has something called Fund Later. These two things are quite similar in their design, but I'll go with the Fund Later one as an example. Effectively, what Fund Later is if you put in $4,000, InvestSmart, the provider of Fund Later, puts in $6,000 as effectively a loan. Now, what happens is you put your $4,000 in, they match it with $6,000, it's a $10,000 investment. Then they invest it into a portfolio of ETFs on your behalf, and you repay the loan over time with a small monthly fee. And the idea is that it gets you into a monthly savings habit, and you get a $10,000 portfolio straight out of the gate, not a $4,000 portfolio. Now, obviously, there are risks, and you should always read the important legal documentation when it comes to this. I'm not getting paid to say any of this sort of stuff, by the way, but I just wanted to open your mind and broaden your horizons beyond just ETFs and let you know that there are other things available. One of the pieces of feedback that we got about some of the leveraged ETF discussion that we've had recently is there's something called, insert technical jargon, there's something called volatility decay that happens with ETFs. And effectively, the losses that are sustained by leveraged ETFs may not necessarily be recovered by the gains. Let me give you an example of this. Let's say you have $100 invested, and that investment falls 20%, meaning you've got $80 left. Now let's say that ETF or that investment now goes up 20%. So it went down 20%, now it's up 20%. For any of the maths wizards out there, you're probably realizing that 20% on top of $80 is less than 20% falling off of $100. And it's something that we like to refer to as volatility decay, and it can happen in markets. So keep that in mind. And if you want to research more of that before buying a leverage ETF, I highly encourage you to do so. All in all, though, I think leverage ETFs are okay. It's just that we do not use them. And I can understand why they have so much appeal in the market, because they are better than some of the alternative things that people do with their money. Don't you worry about that. Next question comes from the Prudent Profit Seeker, who asks, "Hey team, I have been listening to the Rask podcast for coming up on 2 years now and started investing in ETFs as a result." Well, good on you. "Thank you for everything you do. It's a staple of my weekly entertainment slash learning." I'll take the entertainment part, indeed. Infotainment, we can call it. They say, "I listened to the property Q&A from June 8th and then watched Should Owen Redraw Equity to Buy His Farm? My wife and I are risk averse, and before discovering Rask, we focused all of our efforts on paying down the debt on our family home. We are now in a very good position of having more money in our offset account than the current loan." Sounds like a familiar question. "I'd be intrigued to understand the pros and cons of using equity in our home, noting our risk-averse approach. We are both in stable jobs with decent salaries and PAYG. Of particular note was the comment from Chris along the lines of, quote, "You should use debt to purchase shares/property rather than cash from salaries," end quote. "My goal is to reach my financial independence in the next 10 years. Now, the Prudent Profit Seeker, you've given us so much information here that it's probably not as prudent of me to answer this question in its current form. What I'm going to do is just expand on a comment that Chris made and explain what it means. So Chris did make a comment in that podcast, and it was a load of fun because I actually got mortgage broking advice from Chris on my property journey. And he effectively said you should use debt to purchase shares/property rather than cash from salaries. Now, many of you will know that what Chris was talking about was actually using the equity that's available in a property to buy shares. He was not talking about leverage ETFs. He was not talking about anything like Fund Later or NAB Equity Builder. He was definitely not talking about anything like a margin loan. What Chris was effectively saying is that a lot of people pay down their mortgages, not realizing that they can use what they've built up in that mortgage, at least some of it, to then go and invest, either in an investment property or in a share portfolio, like an ETF portfolio that's low cost and well managed. Chris made the point in that episode that this may or may not be tax deductible. Why? Because what you're investing in is income producing. And under Australian law, if an investment is income producing, it will be taxed. That income will be taxed. So therefore, the funding to make that investment may also have tax deductible interest. You should confirm this with your tax agent before doing any of this type of thing. And you should also speak to a good mortgage broker who can help and assist you with structuring your loan the right way. Now, obviously, what Chris was referring to will be helpful for anyone who has a home and has built up equity in their home by making extra repayments, watching the value of their house go up, or simply just paying down the mortgage over time. That's what we call equity. And you can use that equity by redrawing it and then investing. But that's not for everyone. And I think the crux of the question, which was just read out, is ultimately something around behavioral economics. There is no right or wrong answer to how people should fund the investments they make. But the key thing is that using any type of debt to purchase anything, whether it's a leverage ETF, whether it's equity in a home, whether it's something else, maybe it's a loan from a friend, it doesn't matter. Adding debt to something increases the risk, and therefore it is not necessarily the right thing for everyone. That's why I think before considering any of these types of strategies, it's really important to understand why you're investing, what your risk tolerance is, and get used to the idea of investing and how you should go about it that best matches your risk profile, your objectives, and maybe even what your partner has to say about things. Because chances are they're not the same risk profile as you, and you do need to accommodate that. Now, there was another question in this list that did kind of touch on this, and this is more a warning for any of the investors out there that are thinking of using their super. Ash wrote in and said, "I want to know more about SMSFs or self-managed super funds, how they work, how much they cost, and should we use super for buying property inside an SMSF?" Now, when someone says SMSF, I know that's 4 letters, it's an acronym. and then they say property, when you add those 4 letters to the word property, I get tingles down my spine because I know what comes next, at least most of the time. So what is an SMSF? Let's start off with that. An SMSF simply is a self-managed super fund. If you have an Australian super account, which is the biggest super fund in the country, you'll know that you can log in, see that your employer has paid your superannuation on time, and also that your money is invested in things like Australian shares or international shares. A self-managed super fund replaces Australian super in this example. What happens is you effectively have your own account that you manage yourself. That's the self part, self-managed super fund. And what happens is that super fund can do most of the things that a big super fund can do, but there are certain responsibilities that fall on you or whoever manages the self-managed super fund. In times gone by, many financial advisors and accountants would set up self-managed super funds, and they would do it under the pretense that a self-managed super fund will lower costs, give them more flexibility, and help that person invest in the things they really want to invest in. Now, while all of those things are true, and for the right people, like small families, couples, or individuals with larger balances, an SMSF almost certainly can make sense. But for many people who are thinking about starting an SMSF, there are some things you should really know. Number one is it's kind of a misnomer. It's kind of like reading a Tony Robbins book, a self-help book. It's not really self-help. Similar, it's not really self-managed because most of the time you need a lot of technology or experts like accountants and financial planners to actually manage the self-managed super fund for you. So keep that in mind. Sometimes a professional can help you set up one of these self-managed super funds, earn fees, and kind of make you feel a little bit stuck. We come across a lot of investors who invest with us through Rask Invest who have got there because they've become disenfranchised with their financial advisor or their accountant, and they've taken it on for themselves. They've been a bit overwhelmed, and the first thing they've said is, I need to simplify these investments. Where can I invest my self-managed super fund and make it simple for me? So that's not necessarily a pitch for us, it's just in general what can happen. Now, many people who do get into SMSFs have done it for the right reasons, or their advisors have done it for the right reasons. What I would advocate for is making sure that you have a financial planner who is independent of your accountant and vice versa. So don't go to the one-stop shop. Have a financial planner and an accountant who is a separate person and a separate firm. The second thing to note is the costs. Typically, you need a few $100,000 inside a self-managed super fund to make it worthwhile. I'm talking like $500,000. Some people might argue that you can have as little as $200,000 to make it cost effective, and maybe so. But when I was reading the Productivity Commission's report, the suggestion initially was for even more than $500,000 if I'm not mistaken, but I'd say $500,000 is a good line in the sand, keeping in mind that a self-managed super fund can have more than one member. So it may be a husband and wife duo, for example, not just an individual's superannuation balance. Finally, let's get on to the property aspect of this question. A lot of the time inside this finance ecosystem, there are people who, let's say, aren't acting within the rules. And what can happen is, and these are not finance people necessarily, they're not licensed to provide financial advice, but what can happen is they make you believe that the best thing you can do for your wealth is buy a property using a loan from your super fund, because that's where your money is. You'll see a lot of these spooky type property ads on social media, typically coming from Queensland, if I might say so myself. And what they try and get you to do is to buy a property from them using a self-managed super fund that you've gone and set up yourself. The reason that they do this is because property is not a regulated asset, meaning they can give advice on property, but they cannot give advice on shares. And I'm talking about pretty thick commissions here. Sometimes you can get a commission on a property that's 5 or 10%. So if you're selling someone a property like an off-the-plan apartment in Queensland or something like this, and it's a $500,000 property, that person might be collecting 20, 30, 40, 50 grand from selling you that thing. And to be honest, I don't hear many good stories coming out of this. So if you do end up going anywhere near any of these things, independent, good advice from a professional is the only way to go about it. I wouldn't even be brave to extend upon that here, because I know that this area of finance can get pretty hairy and it's very, very nuanced. It won't suit everyone. Please get expert advice. There is heaps of information on the SMSF Association's website, and there are financial planners who are accredited to give SMSF advice. Always check the asic.gov.au website before using any of your money and trusting anyone who might come across as a financial advisor but isn't really. Okay, we've probably got time for one more question in today's episode. We've got another Q&A coming up soon. This question comes from Messy Jessie, who says, how do I know which ETFs to invest in, and how do some of them overlap? A beginner in this game and want some information before diving in. Well, Messy, if that's your first name, or Jessie, we do have something that can help out. We have a free ETF investing course on Rask Education. It's a wonderful thing because it includes both checklists, it includes downloads, includes videos, and some quizzes to get you started on your ETF journey. Thousands of people have already taken it. It's totally free. I'll put a link in the show notes for you. If you don't want to enroll in a course and do all that type of thing, though, you can head to the Rask YouTube channel because Kate, Monique, and I did a wonderful mini-series, the ETF investing mini-series. And I was checking on the weekend in the lead up to today's show and realized that that is actually the most popular playlist we've ever done as part of the Rask group. So if you do want your ETF fill and you're just getting started, our ETF investing mini-series or the ETF course that is available on Rask Education, totally free, is yours, and it will help you no end. Okay, I do want to maybe just explain how the ETF overlap thing works. So if you've ever gone to a party and taken 2 boxes of favorites with you, you probably realize that you probably could have just got one big box rather than 2 of the small boxes of the chocolates, because both of them have the same things in them. I'm pretty sure one of them has cherry ripe. There might be some other things in there like Turkish Delight. I know everyone loves Turkish Delight. I don't, but maybe you do. Put all of those things in and you see that they're all made of the same stuff. An ETF is exactly the same thing. You have 2 ETFs, being the boxes in this case, that have the same things inside them. We had another good question come through that asked us to review the BGBL ETF from BetaShares. We'll do that in the next investing Q&A episode because it is a wonderful exploration of how ETF overlap works and being wary of buying something that may have a high overlap with what you already own. But let's use some examples. Let's say that there are 2 ETFs. One is the Global X FANG Plus ETF, which is an ETF that invests in traditionally companies like Apple, Netflix, and Google. And on the other hand, you have the NASDAQ 100 ETF from BetaShares. Full disclosure, Global X is also a sponsor of our investing podcast. Both ETFs include Apple, Netflix, and Google. The NASDAQ 100 ETF has 100 shares inside it. The FANG Plus ETF has 10 shares inside it. But the overlap is massive because the top 10 companies from the FANG ETF are also represented, or most of them represented, in the NDQ ETF. So in effect, what you have is 10 companies already included in the top 100 ETF. So you have a high overlap score. Now, this is one of the easier examples to explain, but another one in Australia might be, say if you hold the Vanguard VAS ETF, which is the ASX 300, the top 300 shares in Australia, all inside that one ETF. Then let's say you have the iShares IOZ ETF, which is the ASX 200 ETF that holds the top 200. So in one we have the top 300, and in the other one we have the top 200. You guessed it, all of the shares that are in the top 200 are also in the top 300. A high overlap. Now, there's no real easy way to go and check this. Probably the easiest way to check it is on the Vanguard website. They have a tool that you can Google. It's the Vanguard Fund Compare tool. If you Google Vanguard Fund Compare, you'll be able to compare 2 ETFs side by side. But keep in mind that they only compare the top 10 positions. So the 10 largest positions are compared side by side. We also have a tool that's brought to you by Navexa. If you Google the Rask ETF comparison tool, you'll also find one come up, and it does also do a comparison of Australian share ETFs for you. So go and check those out too. You'll be able to have a look at those 2 tools. If you have access to something like Morningstar, you can go further. So Morningstar allows you to buy a subscription and you can go in, you can compare ETFs side by side, and you can have a much better look through the portfolios. Now, as a beginner, you probably don't need to do that. And as a beginner, most beginners listening to this probably don't need to worry about ETF overlap that much at all. Just have a look at what the ETF has inside it by going to the ETF provider's website, seeing which shares are inside it, and making sure that you don't have necessarily two ETFs that do identical things. I'll give you, some examples of where people might have similar things. Say someone owns the FANG ETF, which I mentioned before, just the top 10, and they own something like the VGS ETF from Vanguard, which is 1,500 of the world's biggest shares, all around the world. It owns shares from everywhere you can possibly think of. Obviously, those 10 shares from FANG are going to be included somewhere in VGS. And a lot of people might think, well, there's some overlap. Should I be worried about that? The answer is probably no, because even though the VGS ETF has those 10 companies inside it, the reality is, depending on how you weight the portfolio, they may not be that much inside the VGS ETF to begin with. So for the most part, as long as you're mindful of it and you're aware of it, it's not that big of a deal. Don't overthink it. If you're getting started, just get started and stay on that journey and learn as you go. I think all of these questions that we've heard today can be summed up with a kind of approach that is just be aware of what's happening with your investment dollars. Be aware of what's right for you, because all of us are a little bit different. Now, there were other questions that we received today, but naturally I've run out of time because I talked for too long. So I will start to answer them in the next question and answer sessions. If you do send in your questions, you can send them in via the link in your show notes. But I wanted to leave everyone that listens to this episode, even though it is an investing Q&A episode, I wanted to leave you with a bit of a reflection activity to see how it can help you. This was another thing that was included in Kate's book, Buying Happiness, which I think you can still buy at some good bookstores or online. This is the 10 things reflection activity. It's available as part of the FIRE course on the Rask Education website, and you'll find a link in the show notes. A lot of people go on their financial journey, they start investing, and they don't know what it is that they're investing for. I don't think I truly discovered this until I was around about 30 years old, and I wish I knew it way back when I started my investing, because I would have been more consistent, I would have been happy with what I was saving and investing, and I probably would have slowed down and enjoyed some of life a little bit more than I did. So you can go ahead and complete the 10 things activity that's available in your podcast show notes. It's just a PDF that lists the 10 things that bring you joy and the 10 things that you spend money on, and you try and just draw some lines between them to determine, am I spending money on something that's not bringing me happiness? And what can I do about that? And that's the activity, because from there, you'll start to kind of spur on this idea of being more mindful with money, more intentional with money, and then the investing can help you get to a place where you can hopefully start to enjoy the fruits of your labor just that little bit more. Thank you to everyone that sent in a question today. I hope you enjoy the new format. It's my first run at it, first time back from a holiday, so I'm a bit rusty, but let me know. There'll be one more of these episodes coming up soon, and you can give us your feedback, and I'd love to know what you think. So use the link in your show notes that says ask a question, and you can give us feedback on the Australian Finance Podcast. We love hearing from you, whether it's a question, anything at all, please write into us. I look forward to hearing from you, and thanks for listening or watching this episode of the Australian Finance Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.